President-elect Donald Trump proposing economic policies ranging from tax cuts to tariffs. What does that mean for Wall Street? My next guest says investors may need a whole new playbook. Joining me now, BlackRock's Chief Investment Officer for Global Fixed Income, Rick Rieder. Rick, thanks for coming by.
Thanks for having me. Great.
So in a couple months, we're going to have a brand new president. We've seen it before, but what kind of an economy is Donald Trump going to inherit this time, and what will his changes mean?
I mean, the first thing is, the starting point is the economy. It's in pretty good shape. I mean, we just printed 2.8% GDP, real GDP, in the third quarter, 3% in the second. The economy's in pretty good shape. People keep talking about how the consumer is going to roll over. Consumer's still in good shape. Unemployment, although it's drifted up a little bit, income levels are still good. So he's inheriting an economy that's got some pretty good momentum, certainly relative to what we've seen over prior years. Still pretty good.
He'll bring in some new policies. What are you watching?
Listen, I think how tariffs, how we deal with the debt and the deficits in this country, I think are going to be very significant. Initiatives, he's talked about cutting spending, deregulation of energy, deregulation of the financial system. There's a whole myriad of things that are going to impact the market. Some of the markets like to get in front of it, and then they, sometimes they overshoot on some of these things. So we're watching for a lot of them.
So it sounds to me like that could be both pro-growth, right?
Yeah.
Fewer regulations, et cetera, but also potentially inflationary.
Listen, I think if you build in pro-growth, it's almost definitionally that you're going to have some pricing pressure and some higher inflation on the backside of it. He also ran under the mandate of, I'm going to bring down inflation. So some of the deregulation in energy, some of the financial, and where you cut spending could be significant in terms of how the hope is that as you cut some of the spending, you don't send the economy into a significant slowdown. Same thing with tariffs. You got to be careful about the global growth transmission, and that can have an impact.
Right. So you had a neat quote. You referred to the debt, the deficit, as the shark that's not the closest one to the boat, but it's kind of swimming toward us.
Yeah.
How does the bond market react if the government doesn't do something at some point about this deficit?
Markets hate uncertainty. Markets hate the fact that shark is, as it gets closer. One thing I found about markets over the years is they tend to ignore the stuff that's out there. But when something becomes significant in terms of it could impact the market, it really starts to react. You're starting to see long-end interest rates with some real volatility to them. How does it impact the Fed? How does the Fed think about policy going forward? All those things are going to be significant. Listen, I think the debt in the country is too big. I think we ought to bring the debt down, and we issue so much Treasury bills, Treasury coupons, and you just hope that the markets can digest it. And that's, when things get closer, it's harder for them to digest that amount.
So the Federal Reserve is obviously looking at this. We heard from Chairman Powell on Thursday. The market used to think that the Fed was going to cut more than the Fed said. Now the market thinks it's going to cut less than the Fed is saying in the dot plot. What do you think?
One thing I think is incredible, how markets overshoot. They had, people talk about the Fed's cutting interest rates. The bond market rallied significantly, the front end of the yield curve, and now it's cheapened 130 basis points and it's extraordinary while the Fed's cutting rates. Listen, I think they're going to try and go in December. It is definitely not a certainty they're going to go. Once you get the funds rate down to close to 4%, we're going to have a whole new set of policies. You've got an economy that's strong, and then all bets are off the table. We're going to get from the Fed projections, the dot plot, the SEP projections. They're going to be really interesting. My sense is you're going to see what they call the terminal rate as higher than they originally anticipated. So I still think they'd like to get a couple of cuts done next year, but I think they're going to be patient around it.
But people who want to buy a house might not see mortgage rates as low as they would like.
Listen, I think one of the reasons why I think the Fed has to get the rate down is because you're not seeing any velocity of housing. You're seeing the housing market, existing home sales, housing starts too low, housing affordability is too high. Ironically, if the Fed gets interest rates down, you actually bring down inflation, because what's happening, there's not enough homes on the market today. If you brought the mortgage rate down, all of a sudden, people can start to look at buying homes. The home builders don't have to subsidize their sales with subsidizing the mortgage rate. So part of why the Fed has to get that rate down is a lot of the country really needs to see better housing velocity.
Okay, we should not let you go without talking about your investment playbook. You've got a newish 18-month-old ETF called BINC. That's probably your blueprint. What are you buying right now?
Listen, I think it's income. I don't think any people are going to make any money on interest rates from here. I don't think the Fed's going to be patient. Can you make money in the 10-year interest rate? I don't really think so, or certainly not a lot.
Because it won't be going down much.
I don't think it's going to go down much. It's all about income. We're trying to create a portfolio. We are creating a portfolio that's between 6 and 6.5% yield, diversifying using mortgages, using securitized assets, using credit, high yield investment grade. diversify it, clip 6.5%. And just it's a great environment. You think about, most people say, gosh, if you can get me 6.5, that's pretty good. And maybe rates come down and I can make more than that. That's get income and do it in a stable way where you don't take a lot of interest rate risk.
Especially with stocks at 22, 23
Totally.
PDE, that looks pretty good. Thanks
Totally.
very much, Rick Rieder.
Thanks for having me, Joe.